Medical Properties Stock, ticker symbol MPW. Is this the best REIT to buy right now? MPW is down almost 42% on the 1 year chart, which is quite a difference with the overall market. The S&P 500 is down 8%. On the 27th of October, MPW presented quarter results where they missed on both FFO and revenue by a small margin. For the upcoming earnings presented on the 23rd of February, almost all analysts expect a miss. The reason why people love MPW is because of the dividends. Dividend yield sits at roughly 9% and they have grown the dividend for more than 10 years in a row. But does this mean that MPW stock is a buy at current prices, or is it a dividend trap? Well, in this video I'm going to show you real quickly what MPW does, the most recent earnings, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does MPW do? MPW is a real estate investment trust that invests in healthcare facilities subject to triple-N leases. If we dive in the latest earnings report, we see that they reported a net income of $30.7 and an NFFO of $0.45 per diluted share. They also announced dividends of $0.29 per share, and based on the AFFO, the payout ratio is at 81%. So this is one of the main questions I get with MPW. Payout ratio is looking really good. The average for REITs is around 75%, so they are slightly above this average. Next to that, sale of 11 facilities and a significant reduction in short-term debt, which is also pretty good in my opinion. As I told a second ago, net income reported $0.37 versus $0.29 prior year period. So this looks quite good. A steady increase. However, NFFO is not increasing that great, so keep an eye on that number. The company is increasing its estimates of 2022 per share net income to $1.99 to $2.01, and it's also tightening its estimates of 2022 per share NFFO to $1.8 to $1.82 from a prior range of $1.78 to $1.82. So this looks also quite good to me. The 2023 estimates will be announced in the next earnings report on the 23rd of February. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. MPW is a 7.6 billion market cap company with a PE ratio of only 6. But since this is a REIT, I don't want to focus on the PE ratio, but use the price to FFO. Price to FFO is at 7.3, which is significantly lower than my maximum number of 16. So this could indicate that MPW is undervalued right now. Later in this video I will show you my 3 price targets for MPW, so make sure to watch until the end, since price to FFO is only telling a small part of the full story here. Revenue is at 1.57 billion, and in this graph we see that revenue is going up really nice and steady, which is something that I really like, of course. During the lockdown periods, revenue increased quite a lot. The question is, can they sustain this growth? Most recently we see that revenue is going down a bit. Over a longer period of time we see that margins are going up, which is of course something that I like. EPS is also going up in the past couple of years, so this looks also really good to me, especially for a REIT. Analysts expect EPS to decrease quite a bit in the coming years, which really hurts to see, of course. Revenue is also not looking that good, but okay, we have to keep it in mind when creating the price targets. Return on assets is sitting at 3.1%, which is the average for a REIT, and it's the same story with return on equity. Return on invested capital, the most important number here, is at 3.9%, which is kinda low, even for a REIT. I really like it when the current ROIC is higher than the 5-year average, so this is also looking pretty decent. Current ratio is at 1.98, which is around my preferred number. On top of that, I really like it when it goes down as it did in the past couple of years. A thing to keep your eye on is the total debt and total cash. I prefer companies who can pay down at least a third of the total debt with the total cash. Right now, total cash is at 299 million, while debt is at 9.48 billion. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to do acquisitions, buy back shares and all other things. In here we see that free cash flow has grown quite a lot in the past couple of years and is also quite steady and consistent, so this is something that I really like. If we check the shares outstanding, we see that it's going up quite a lot in the past couple of years. Usually this is not a good sign, but REITs issue new shares to raise capital and grow the business, so I'm not worried that much about this number. Next up are the dividends. Dividend yield is sitting at 9%, which is a really high number in my opinion. Annual payout is at $1.16 and earlier in this video we saw the payout ratio is around 80%, so this 55% isn't correct. The 5-year average growth rate of the dividends is at almost 4%, which is not that high. But I'm okay with that since they grew the dividends for 10 years in a row, which is quite impressive and is already at 9%. But does this mean that MPW stock is a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 1% because of what we saw in the earnings report and also because of the analysis estimations. For the mid assumption I'm filling in 3% and for the high assumption I'm filling in 5%. For the profit margin I'm filling in 70, 75 and 80%. For the free cash flow margin I'm filling in 50, 52 and 54%. PE ratio is not the correct metric to use for a REIT, but we have to fill it in, so I'm putting in 10. For the price of free cash flow I'm putting in 10, 11 and 12, since this is a slow growing company and I don't want to overpay for this growth. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I use 12.5%, but I want a higher margin of safety with this company. Right now MPW is at $12.44. I hit analyze and we see a few green numbers. I don't pay attention to the PE ratio since this isn't a great way to value a REIT, so I'm only focusing on the discounted cash flow value. We have a low price target of $10.46, which is a decent drop from where they are right now. A mid price target of $12.8, which is right above the current stock price, and we have a high price target of $15.72. To me the mid to high price target is the most justified here, since I expect growth to slow down just a little bit and the rest of the numbers stay at current levels. That would mean they are right around the fair value. My final conclusion is that stocks with a dividend yield of 9% or maybe even more are always attracting a lot of attention. And with reason of course. 9% dividend yield is an insane number. But be aware that when revenue slows down or something else happens, the dividend might be at risk. Personally, I don't want to have too much high dividend yielders in my portfolio. I think it's a decent company with some pretty okay fundamentals. Revenue is something to keep your eye on, and it's the same story with the FFO, one of the most important numbers with REITs. I don't think they are massively undervalued right now, and for that reason I will skip this stock for now. Next to that, I already have 2 high dividend yielders in my portfolio and I don't want to take too much risk. Nevertheless, it's still a decent company that can bring in a lot of dividends, so if that's what you're looking for, this might be a great addition to your portfolio. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.